Hey, how's it going, everyone? Should I buy the food stocks dip? Are food stocks a buy right now? Today on the Dividend Compounder Show, we're going to talk about just that. So, what exactly is going on? President Trump is currently building out his White House administration with people who helped or supported him during his campaign, and he has made good on his promise for a guy named RFK Jr. As a result, food stocks are going through a massive sell off right now. Speaking of which, what you see on your screen right now, the memes, during a health checkup, his doctor found a parasitic worm in his brain. And so some people are joking and saying that the worm in his brain is telling him to go on this war against food. As you can see right here, it says the worm in RFK Jr.'s head telling him to ban Diet Coke and Fruit Loops. And over here on the right side, the worm in RFK Jr.'s head convincing him to squeeze the seed oils from every American. Because the thing is, RFK Jr. has been given freedom by Trump to go wild on all things related to our health, because now he will be the head of the HHS, the guy you see on the right side of your screen that's shirtless with huge deltoids, biceps, and triceps. Just everything on him is just bulging. The Health and Human Services Department oversees the CDC, the FDA, the NIH, the CMS, and much, much more. So if you don't get it by now, JFK Jr. is a guy that is going to go after the pharmaceutical industry and the food companies. He's been saying that since day one of his own presidential campaign. But after he dropped out and endorsed Trump, Trump is now rubbing his back, which in effect, he's going to rub our back. And the dirty little worm that's inside of his head is telling him to wage war on these industries that we just talked about. So consequently, the market is selling out of stocks due to fear of what is to come. They're not sure what's going to happen. And whenever there's uncertainty or fear, the market sells. We see this time and time again, without a doubt. And that's when, as retail investors, you get a chance to go shopping. For me, I see this as a buying opportunity because I'm an idiot and I think this is a really good chance. And this is a once in a while chance, so why not is my thought process. And not sure if you understand who JFK Jr. is, but this dude is 70 years old and he's jacked to the tits, as we just talked about, right? Even his nipple right there has a six pack. And because this is the guy driving the health ship, I think this is going to benefit the average American because their foods and drugs are going to be healthier moving forward, or consequently due to his restrictions, regulations, and when he lays down the hammer. So JFK Jr. is specifically targeting foods that use artificial ingredients and sweeteners that may or may not be bad for us. Like what you see on your screen right now is the ingredients for Fruit Loops, which is a cereal made by Kellogg's. And I think he might be onto something. I have not done my own due diligence and research, but I feel like eating red 40, yellow 5, blue 1, and yellow 6 probably is not the best for us. So if RFK Jr. wants this stuff to go away, he has my support. On the other hand, Wall Street is overreacting as if these companies are going to go bankrupt due to the upcoming restrictions. But what I think is going to happen is that food companies are going to go to the drawing board and figure out another way to color their cereal. Right now, they're using some really artificial, synthetic stuff, yes, but I don't know. I feel like it's not going to be the end of the world. Yes, their profit margin might be affected, but Fruit Loops, gummy snacks, potato chips, and whatnot are not going to disappear. The ingredients are obviously going to change to be healthier, for sure. But if you think for 1 second that Americans are just going to go vegan because of this, like, oh, I'm not going to eat this stuff anymore, or the food restrictions being modified to the point where these companies go bankrupt, then dude, you have small feet and you're delusional. The fact of the matter is, food is going to be here today and it's going to be here tomorrow. So let's go ahead and investigate which companies I think are decent and buying opportunities right now. So you see, the more time that you spend on TikTok, the more your attention span will be cooked. And cooked is something the kids say these days to mean your brain will be fried. So what you see on your screen right now will be the flow of the video. That way you can skip around if you need to. And speaking of skip, the next time a half-naked woman appears on your social media feed, you better skip that as well. Because if you don't, I'm going to go ahead and tell your wife's boyfriend and her handsome Brazilian Jiu-Jitsu instructor. I'm going to tell both of them, and we don't want that to happen. Bottom line up front, these are the companies that, in my opinion, should have a healthy rebound or just continue to dominate after all of the fear in the street settles. Once the dust settles, these are the ones that I think will be the true winners. And we're going to expand on each one here in a little bit. But before we do that, here are the honorable mentions. Number one is going to be sweet green. And no, I'm not talking about that type of green herb, but it's a salad bar type of fast casual food joint that looks and feels like Chipotle or Cava. And I'm personally not bullish on this company, but think about it. To the average person, when the options are a burger or a salad after working at the warehouse or driving for Uber for 12 hours, what do you think they're gonna go for? They're probably gonna go with the burger and fries every single time. However, with that said, I can see Sweet Green riding on the healthy food momentum that seems to be all of the rage right now. I think more and more people are starting to be cognizant and aware of what they put into their body. So Sweet Green might have some short-term success, but in the long run, I'm not sold yet. And number two, we have Hain Celestial Group. And reason being is that they already make healthy snacks. Hain is a preview of what PepsiCo's Frito-Lays could look like if they decide to go 100% healthy, all in. So I'm slightly bullish on Hain because with the whole healthy food movement going on, I think they're gonna get some spotlight and gain some market share. And then number three, out of these three honorable mentions, I'll be honest, Starbucks is the biggest reach. And no, it's not that they're being hit by the speculation, it's just for the past few years or so, they have been trading flat or in a decline because the company was struggling with the previous leadership's mismanagement, China issues, and customer retention problems. But here's what I think. Right now, Starbucks is known for their bean water and holiday drinks, right? Like the pumpkin latte and the Christmas specific drinks. However, when they make that pivot to becoming a healthy snack bistro along with those drinks, I'm telling you right now, it's going to be game over. It's a wrap. Everyone else that's in the coffee business will not be able to compete with Starbucks. And just think about this with me right now. Imagine when Starbucks start to offer fresh fruit smoothies and protein-focused drinks for the meatheads out there. Instead of just coffee, they can be rebranded as a one-stop shop, a healthy place to meet all of your needs, whether it's caffeinated drinks in the morning or after your workout at 5 p.m., that protein shake, they can do it all. As a matter of fact, if you work for Starbucks, come hire me. Dividend compounders with cheese, more than willing to help you out. So now let's go ahead and talk about my investing thesis for each one of the companies that I am bullish on, the winners. The first up is going to be Walmart. I know, when you heard that, you probably rolled your eyes, but hear me out. Walmart is currently near their 52-week high, and that's because Walmart is dominating the retail scene and their e-commerce business is gaining market share from Amazon. But more so than that, I think Walmart is going to be a big winner because of their great value brand of foods and snacks, what you see on your screen right now as example. That's the in-house private label food that's stocked all over their grocery shelves. And the thing is, they tend to have a reduced amount of artificial ingredients in comparison to brand name foods of the exact same item. Sure, the taste might be a little off, but the ingredients will be less of a target on their back from RFK Jr., Bobby Jr. Can I just say Bobby Jr.? Okay. Not only that, Walmart is gaining market share in the grocery space every single year for the longest time. It's a trend that does not fail. In fact, currently 1 out of every 4 shoppers do their groceries at a Walmart instead of at a standalone grocery store like Food Lion, Giant, or even Aldi. Imagine that. However, on the other hand, Kroger's has been losing their grocery market share every single year that Walmart has been gaining. So what I think is happening is the customer base for Kroger is slowly making their way, sashaying, to Walmart because for the exact same grocery items, the bill will be slightly in your favor if you go to Walmart. I mean, their slogan is what? Save money, live better. Not only that, if you need to buy some Rogaine for your bald-ass head alongside with your chicken drumsticks, you can do that at a Walmart. So what I'm trying to say is the investing thesis is this. Eventually, like 10 to 20 years out, 50% of all grocery shoppers will choose a Walmart. And based on that, the opportunity for Walmart to sell their great value brand is gonna only increase. And I think that's something that is happening, right? I think more and more people are realizing that the off-brand stuff is just as good as the name brand stuff. And that's why people that shop at Costco, if they have the option between the Kirkland brand and the name brand stuff, more often than not, people are now not hesitating to go with the Kirkland brand. Likewise, at Walmart, if they see the great value branded Cheez-Its right here versus the name brand Cheez-Its, they'll probably just go with the Walmart brand. Because once you try it, you realize like, dude, food, it's not that far off. The only category and item where you just cannot replicate it to the point where it's apples to apples is Coca-Cola. Apparently, Coke has a very distinctive flavor that you just cannot try to emulate. So Coke is in a whole different category, and I think that is one of their economic moats. But this is a video about Walmart. Unfortunately, I would argue that Walmart is slightly overvalued. But if Walmart ever goes on a dip like Target did when they did the marketing campaign last year and people just sold out at Target to punish them, if that ever happens with Walmart, I would think that it's an opportunity for me to buy shares of Walmart. However, knowing the DNA of Walmart, they operate with a more safe and conservative mindset when it comes to stuff like that. So I don't know if a ballsy marketing campaign is ever going to come out of Walmart for their stock to crash, but if anything happens like that, that would be a buying opportunity for me. Next up, we have McDonald's. And there's many reasons to like McDonald's, whether it's because they're a real estate company disguised as a food chain or because their cafe drinks are gaining traction. All around the world, more and more people are opening up to the idea of stopping by a McDonald's at 7 a.m. before work to grab a cup of coffee. And not to mention Cosmic, their drinks-specific cafe as a standalone business. But I'll tell you what, McDonald's is on this list because once they start using beef tallow for their French fries, it's a wrap. For all of the other burger joints, they will not be able to compete with McDonald's because even right now, I think McDonald's French fries taste the best out of all the other burger joints. But once they start utilizing beef tallow again, I'm telling you, pack up your bags, start up the bus, and just go home. McDonald's is going to be the winner. And on that note, McDonald's has slowly been making that pivot from being the budget-friendly burger place to being more of a corporate, clean-cut dining establishment. Standardized and consistency is what makes In-N-Out, Chipotle, and Cava successful. So I get it. I understand their strategy. But between you and me, I genuinely miss how each McDonald's location used to be unique and had their own specific atmosphere, right? They had their own style or decoration. Back when I was getting my MBA in Williamsburg, Virginia, there was a McDonald's that I used to frequent, and inside of that McDonald's, they used to have a vintage car right in the lobby and a whole bunch of 1950s, 60s, and 70s decoration. And I can tell you right now, all of that is probably gone, and it's standardized. As a restaurant or dining establishment, what you want is to give the customers an experience that is consistent across the board. That way, if you go to a McDonald's in Seattle or in Paris or in Tokyo, you feel and you taste the exact same McDonald's. And some people might disagree and say that sucks, but it seems to be a successful and working formula for all of the other companies that decided to go for a standardized look. And other than that, their supply chain is world class. And for the longest time, they had healthy alternatives on their menu. However, the numbers were just not there. So McDonald's and the leadership team decided to double down on the savory and delicious options instead. They used to have the fake meat burgers, the Beyond Meat, Impossible Meat, but people were just not wanting that because it doesn't taste as good as the real 100% beef patties. All that to say, it's a company that wasn't afraid to experiment and to test ideas out there. However, based on the feedback and customers, it's better to just go with the quarter pounder, the McRib, the chicken nuggets, the meat. The meat is the umami, the savory, the deliciousness that brings the customers back. They're not going to be waiting in a drive-thru for 5 minutes to get a very cold and disgusting and dry piece of Impossible or Beyond Meat beef patty. It's just not the same. And something that you have to realize is that outside of the US, the eating habits of people are completely different from us. Unless you live in Germany or Brazil, then it's probably similar to us fat, obese Americans. But for the most part, people around the world, they tend to eat healthy food for 3 meals a day, 21 times a week. So McDonald's is seen as a guilty pleasure that people actively seek out. Like they know that it's not going to be the healthiest food option, but you eat McDonald's for the taste. You don't go to McDonald's for the healthy factor. Does that make sense? But when we think about McDonald's internationally, they have been operating under each country country's rules and regulations regarding food ingredients. So McDonald's already has the blueprint, operation, and game plan in hand to make those modifications to their restaurants in the US once those rules come down to them. Does that make sense? McDonald's is not going to be caught with their pants down to their ankles since they already have experience running a McDonald's in Japan, Scandinavian countries, and Singapore. These are all places where food regulations are a lot more strict than the US, so they already know what to do. So the investing thesis is this. For one, McDonald's already has a formula in making a cleaner and healthier version of their food. And number two, people seek out McDonald's not because it's healthy, but because it tastes good. They know deep down inside that it's not good for them. But what brings them back is the flavor and taste. So despite like the healthy food mandate coming down to them, depending, right? It's not guaranteed or definitive yet. People are still going to go to McDonald's. All that to say, when we think about McDonald's, worldwide or in the US, people think of it as a cheat meal, a comfort meal, an easy meal, whatever you want to name it. After a long day at work or when you don't want to make food for the kids, McDonald's is there for us. McDonald's is going to be a part of the food culture, whether you like it or not. And so for me, I'm super bullish on McDonald's. If it happens to go on a dip because of the new food guidelines, I'm going to be there like it's Black Friday, picking those shares up happily. And next up, we have Hormel. Hormel is in the business of protein, fresh meat, and canned meat. What you see on your screen right now is the Korean variety of Spam. And believe it or not, in Korea, people actually give cans of Spam as a gift for anniversaries, Christmas, or promotions, or just celebrations in general. Different culture, different way to do things. So if you don't get it by now, Hormel's bread and butter is Spam, which currently has about 50% of the market share in the canned meat market. Which, by the way, not just the Koreans, right? Spam is also a fan favorite among the doomsday preppers, camping hikers, the Hawaiian, the Filipinos, college students, and people who do the keto diet. It's keto friendly, so believe me when I say some scrambled eggs and grilled slices of Spam is a pretty mean breakfast. If you don't believe me, try it out. You have to thinly slice the Spam and grill it on the pan for like a minute or two on each side. I know it's already cooked, but when you grill it, my goodness, it gives it that extra flavor. And to eat it alongside with some scrambled eggs, my friend, it's gonna slap you across the left testicle. You gotta just take my word on it. And when we think about their biggest opportunity, it's not just the canned meats, right? But rather, it's the Planters Nuts division. Yes, Planters Nuts is owned by Hormel. And when you think about it, all the different varieties of nuts, especially like peanuts, excellent form of protein, and it comes in so many different flavors. There's honey roasted, salted, sweet and spicy like your dog, and when I used to do bodybuilding back in college, I actually ate an entire container of these once a week, and my favorite flavor was honey roasted. So when it comes to Hormel, the only issue that I see is that their products tend to cost more than their competition for the exact same food or snack. So some people might see that as an economic moat in pricing power. And on the other hand, some people might beg the question, well, what happens when another canned meat company comes along and they only charge half the price? Are they gonna still pick up the Spam that's gonna cost twice as much? So that's something to take into consideration, but in the grand scheme of things, there's a lot to like about Hormel. If you want to learn more, then go ahead and watch my deep dive video that I made on Hormel so that the rest of us can move on to the next company, which is going to be PepsiCo. PepsiCo is home to chips, Gatorade, and soda. So will the pending healthy ingredients mandate smack them right in the balls? Yes, but I think in the long run, it's going to be good for them. Hear me out. The beauty of investing into PepsiCo is that if you invest into PepsiCo for the Frito-Lays, you also invest into their beverage division as well. And Pepsi's portfolio of brands is pretty diverse and big. It's like a conglomerate of food and drinks that all have a winning recipe and success with the consumers. And if you look at the chips aisle at a grocery store, I'm going to tell you right now, it's predominantly PepsiCo brands. They own about 40 to 60% of the chips market share, depending on your geolocation. But the thing is, PepsiCo's leadership is not just waking up in 2024 and reacting to the consumer and market trends and saying, oh, we need to do something about that today. Rather, they've been playing the long game because they also have brands in their portfolio like the Health Warrior, Nut Harvest, Off the Eaten Path, and Popcorners in their portfolio. Like, doesn't the chickpea veggie crisps sound delicious to you? No, between you and me, that sounds disgusting. Or the nut and fruit sweet and salty trail mix? Oh, that's the nickname you give to your boyfriend. And then we also have a chia seed bar. Okay, all of that sounds really gross to me, but I know that's just me. Because I prefer potato chips or cheese sticks. I don't really care about all of these granola type of snacks. Yeah, I'm weird. But the point that I'm trying to make here is that PepsiCo future-proofed their business ahead of time by adding all of these different healthy snacks to their company. You love to see it. And now that I think about it, because I prefer potato chips and cheese over these healthy alternative options, that probably explains why I'm overweight. Before I lose my train of thought, 9 out of 10 times, it's so much better for a business or a company to be proactive and to look into the future and make that slow transition in order to stay relevant with the consumers than it is to have a business that have their backs up against the wall and they're trying to figure out like, who are we? And then for them to do desperate business decisions in order to stay relevant with the consumer. And there's so many businesses and companies over the years that went bankrupt when they stick to that plan. That's why when I see a company that stays ahead of the curve and makes innovations and takes calculated risks in order to resonate with the consumers, I would prefer that being in my investment portfolio than a company that plays it way too safe to the point where their products and services become obsolete. And then for them to panic and say, okay, we're going to try to do this now, aka Intel. And last but not least, we have General Mills. I'm in particular very bullish on General Mills because right now they're going through an unwarranted sell-off because everyone is fearing and dooming about the healthy food ingredients mandate. And so as of right now, I think they're in an undervalued category. I don't know if you know this or not, but General Mills is not some stupid startup that just started like 20 or 30 years ago. Believe it or not, General Mills has been around since 1856, which means that they have been adapting and evolving with the times. The healthy food ingredients mandate is just going to be another hurdle in their history and timeline that I personally think they're going to get through just fine. They have over 150 years of thriving as a company. And as you can see on your screen right now, General Mills, when we think about them, some people only see the cereal, right? But they're so much more than a cereal company. They also make pet food, Blue Buffalo. But anyhow, General Mills is a long-term value play. And when I say that, it's because I'm thinking about their other business segments. These guys are also staying ahead of the curve. Annie's homegrown of like organic products, yes, they have that. The Larabar for hikers and the granola type of people, they have that. They have Ratio, what you see on the left side of your screen. Epic, which is their meat jerky snacks. I didn't even know they had meat jerky. They have Autumn's Gold, Yoplait, aka yogurt. Everyone and their annoying neighbor knows how important probiotics are to have in your gut because your gut health pretty much dictates your immune system. And they also have a snack called Good Measure. So I think with their offerings and mix, General Mills is going to be in a good position for the healthy food movement that's coming. But that does not negate the fact that a bulk of their portfolio is still in the cereal business, and everyone knows that cereal is pretty unhealthy because the amount of sugar and food coloring in each bite, it's enough to make your nipples sweaty. However, stop right there and just imagine with me. When the changes are made and they substitute and swap out those artificial ingredients with like natural and healthy ingredients, and the word gets out that cereal is now healthy, just think about the demographics of people that are going to resonate with that. Right? Because right now, breakfast cereal is only really popular with the millennials and Gen X. Everyone else, including the baby boomers, Gen Z, and the younger ones, they don't like breakfast cereal. But once everyone understands that breakfast cereal is healthy, I just think about the cash flow and revenue and the customer segment being diversified beyond their target demographic of the millennials and Gen X. If every age group starts eating that breakfast cereal, oh, game changer. Speaking of which, they already have Cascadian Farm Organic Cereal, what you see on your screen right there, the oats and honey granola cereal, which might be a preview of what breakfast cereal is going to look like going forward since they already have a recipe and a brand under their portfolio. Listen, between you and me, I'm not the biggest fan of eating cereal for breakfast because I prefer fresh fruits, vegetables, and eggs. However, my wife likes it. And actually, she loves it. So if there's cereal in front of me, am I gonna reject it? No, of course, I'm gonna eat it. Likewise, I'm a guy who sold his car to use his bicycle to ride around town. Yes, as a 30-something-year-old, I'm a guy that pedals his way to work or to the grocery store. I'm that kind of guy. But I'm never going to protest the idea of getting a ride from someone, especially if it's like 40 or 35 miles out. Because for me, I think my distance limit is about 25 miles or less. If I have to pedal my ass over there and be covered in sweat, so be it. But when it's like 40 or 50 miles, then I would be more than thankful if someone offers me a ride. And any sane person hearing that will ask the question, why? And to that I say, biking instead of driving for a daily commute is so much more fun than you think. And that's coming from a guy that used to be into sports cars, muscle cars, racing, engines, and everything. But I gotta say this. Riding a bicycle as an adult is just one of those things where you have to try it. To feel the wind in your face and you using your own body to move you from point A to point B is just a phenomenal feeling. And not only that, you get your cardio in for the day. If you ever had a bicycle as a kid, try riding a bicycle as an adult. I'm telling you, it's just one of those things where you gotta try it. It's hard to be convinced otherwise. Just get your ass to a bicycle store, try one out, you'll thank me later. Especially when you start losing the beer belly around your gut and you start shedding 10 to 20 to 30 pounds a year, you're gonna love me. Now we're going to review their total return for the past 20 years while taking into consideration their dividends and share buybacks. First up is going to be Walmart. For the past 20 years, your total return would have been 550%. Pretty respectable with a capital R. I would not complain if that happened to me. No, it's not get rich overnight kind of thing like cryptocurrency, but investing and dividend investing is a whole different mindset, so I'm okay with a 500% rate of return. Next up, we have McDonald's. And I'm going to tell you up front, this one is not like the others because McDonald's has had the best performance out of the 5 winners. And that's because their operation, French fries, and they prioritize bringing value back to the shareholders. Anyways, in the past 20 years, your money would have grown by 1,500%. My goodness gracious. Delicious dividend compounded with cheese right here. With Hormel, the total return would have been 450%, and that's because the food industry as a whole for the past 3 to 4 years has been taking a hit. With PepsiCo, the total return is 430%. I think that's still pretty good. And last but not least, we have General Mills. Your money would have grown by 420%. So it seems like all of the food companies have similar numbers. And in order, Hormel gave the best return at 450% by a tiny margin, and then second would have been PepsiCo at 429%, and General Mills at 423%. All 5 of these, in my opinion, I think it's really fantastic total returns. And now we're going to review their dividend profile. First up is going to be Walmart. The dividend yield is currently just shy of 1%, which means for every share of Walmart that you have, the annual dividend payout is 83 cents, and they have been growing that dividend for 52 years. And they have been growing this payout at a rate of 1.8% each year for the past 3 years. The dividend payout ratio is 43%, which tells me that it's really healthy, sustainable, and there's a lot more room for growth. I think they're being a little stingy because they can afford to grow the dividend by at least like 5, 6, 7% instead of 1.8%. And for the past 20 years, the dividend yield, the average is 1.6%. And currently it's just shy of 1%. This tells me that with Walmart, the growth in the stock price outpaces the dividend growth by a whole lot because the stock price is moving faster than the dividend can keep up with. In other words, it acts like a growth stock that has a nice and stable dividend that has endured through 50 years worth of trouble, economic downturns, and fear. So Walmart as a company, I like it. But as a dividend investor, of course, I'm not happy with a 1% dividend yield. But knowing that the growth in the stock price is making up for that, especially in the total return picture, you got to look big picture long term. If the growth of the stock price makes up for the small dividend yield, then it's okay. okay. But if the stock price doesn't grow as much, then it better have a high dividend yield. Anyways, moving on is going to be McDonald's. Current dividend yield is 2.2%, which means for every share of McDonald's that you have, you get paid $6.68 in dividends a year. And McDonald's has been growing their dividend for 49 years. This has been going up in value for 49 years. And they grow the $6.68 in dividends by 7% on average year over year. And the dividend payout ratio is still pretty healthy at 58%. And for the past 20 years, the average dividend yield is 2.3%. And right now, it's sitting at 2.2%, which means the growth of the stock price and the dividend are both growing at a rate that complements one another. And a dividend yield of 2.2%, I think that's pretty respectable, right? It's nothing to brag about or to write home about, but a 2.2% dividend yield, having the perspective that other restaurant stocks were cutting their dividends through macroeconomic conditions, such as during the COVID-19 pandemic, whereas McDonald's did not, and in fact, they increased it 49 years, it tells me that this is a very high quality company that has their finances in order, operations in check, and once again prioritizes the shareholders. What's there not to like about this company? And there's even a $5 meal deal. Next up is Hormel. Their dividend yield is 3.8%. Now we're talking. I would say that's a good dividend yield. The annual dividend payout is $1.13, and Hormel has been growing their dividend for 59 years straight and going. The average growth rate of this dividend right here is 5.7% year over year, and the dividend payout ratio is just shy of 80%. And I know it's red, which means like, hey, red flag, but for me, anything less than like 85% or 90%, I would say is okay. Of course, you want it to be as low as possible, around 50, 60%, but Hormel is operating in a very mature industry. So to see 79% for me, not even going to sweat about it. If, however, this dividend payout ratio was around 90% or 95%, yes, that's a red flag. And for the past 20 years, their dividend yield was around 2.3%. Right now, it's 3.8%. So what I am seeing is that the dividend yield and the growth thereof has been outpacing the stock's price movement. Because as of recent years, their dividend yield has been getting bigger and bigger at a rate of 5% year over year, where on the other hand, their stock price has been trading flat or on a decline as of recently. I think for the last 3 to 4 years, Hormel stock price has been relatively flat. And unfortunately, it's the exact same story with PepsiCo. We're going to start from the bottom right here. For the past 20 years, the average dividend yield has been 2.7%. Okay, for the past 20 years. Right now, their dividend yield is 3.4%. By the way, I'm using a picture of Doritos because that falls under Frito-Lay's, which falls under PepsiCo. So the dividend yield, I think it's quite nice at 3.4%, which means for every share of PepsiCo that you have, you get paid $5.42 in dividends, and they've been increasing this dividend for 53 years straight. And they grow this payout of $5.42 at a rate of 7% year over year. And their dividend payout ratio is just shy of 80%, just like Hormel. So as I evaluate their dividend, I still think it's pretty good, but I do have to keep in mind in the back of my head that their stock price has not been keeping up with their dividend growth. And I don't know if you're tracking or not, but all of the food and restaurant stocks have been struggling for the past 4 years because with the pandemic, COVID-19, staffing issues, supply chain issues, and inflation, their margins and everything across the board has been getting hammered. So that explains why their stock price has not been outpacing their dividend and dividend growth. And lastly, we have General Mills. Their dividend yield is 3.8%, which means you get paid $2.40, their annual dividend. General Mills has been growing this dividend at a rate of 4.5% year over year, and the dividend payout ratio is 57%, which is healthy and good and sustainable. And for the past 20 years, the average dividend yield has been 3.1%. Right now, it's 3.8%. However, I don't know if you noticed this or not. Unfortunately, unlike the others in this list, General Mills has not been growing their dividend for decades. Which tells me when the company goes through some speed bumps, the leadership team prioritizes the business first and foremost, and they think long term. Instead of increasing the dividend while the company suffers, the leadership in their DNA, history, and timeline, they choose to save and prioritize the business instead. And I think when a company does that, they are prioritizing the shareholder, because if they pay for the dividend by taking out loans and tackling on more debt, to pay that dividend to increase it, then the company's finances, balance sheet, and earnings per share is going to take a hit. And I say that because sometimes when a company has a reputation of increasing their dividend year over year for 20, 30, 40 years, and the company is a dividend aristocrat or a dividend king, then they're going to do whatever it takes to continue that trend, even if it means putting the company's finances in jeopardy like we just alluded to. More often than not, it's better to focus on the company's operations, balance sheet, and growth than it is to increase a dividend that they cannot afford. Key word being they cannot afford. If everything else looks good to go, then that's when a dividend should be prioritized. But if there's a company that prioritizes the dividend first and foremost, then in my opinion, they're making questionable decisions. Because when that happens, my first immediate thought and reaction is maybe the leadership team is not looking out for the company's best interests, if you know what I mean. If they're prioritizing that dividend just so they can keep their job as a CEO and they're letting the company burn in the background, that tells me like this guy is not looking out for my best interests. That's why as a dividend investor, I think of dividends as the cherry on top. Only after everything else looks good should they afford and increase that dividend. If they're going through a setback, yes, that's when I want them to pump the brakes. Not exactly cut the dividend, but you can keep the dividend payment the same for this year and for the next year and use that extra cash on hand to tackle the issue at the top of the list. So as a dividend investor, I fancy a company that is doing so well in all areas of the business that they have cash left over to return back to the shareholders in the form of buybacks and dividend increases. I do not invest into companies just because they pay a high dividend. Everything else needs to look pretty and smell good first and foremost for me to even consider them. Though I think this is very important to call out because I don't know if you're aware of this or not. In General Mills' defense, they have been paying a dividend for over 124 years without missing a payment. So it's not like this company is trash when it comes to dividends. 124 years of consistent dividends. No, it hasn't been growing every single year, but that dividend has been coming through. But it's worth mentioning because if you invest into General Mills, sometimes you might expect the same dividend payout as the year before if the company is going through a tough time or busy shoving a pickle right up their butthole. And to measure the company's debt levels to see if it's manageable or not, we're going to refer to the debt to equity ratio. You can read the definition that's on your screen right now. And why are we taking this into consideration? Well, in simple terms, it's hard or difficult or a challenge for a company to go bankrupt if they have little to no debt on hand. If, on the other hand, they're highly leveraged and debt is the only way they're able to run their business, then any little setback will have the potential to knock them down like Jake Paul did with Mike Tyson. I can't believe I even said that sentence right now. Can you believe this fight happened very recently? Jake Paul, who is 27 years old and in the prime of his life, the guy that you see on the left side of your screen, went 8 rounds with a 58-year-old grandpa Mike Tyson. Talk about an unfair matchup, like a band of Mexican families hitting up a Chinese buffet on Sundays after church. If you ever go to a Chinese buffet on a Sunday afternoon, I'm telling you, it's going to be more crowded than usual because of the after church crowds. So as a heads up, pro tip, if you go on a weekday instead, not only is there going to be more sushi available on the tables, but the price is going to be a little cheaper as well because I think they add a premium fee for the weekends. And I don't know, this whole fight made me so sad because I don't know what his financial situation is for him to agree to this fight, but I just felt sorry for the poor guy right here. Because in his prime, Mike Tyson was a menace to society, right? And now as a 58-year-old to fight against a guy who's half your age, you hate to see it. Anyways, back to the video. When it comes to the debt to equity ratio, lower the number, the better it is. However, it's also contingent upon the industry and sector as well. Sometimes running on debt is the standard for companies that are REITs, utilities, startups, etc. Topping the list, the best one is going to be Hormel. Their debt management is the best among the five. And then Walmart is also really good. Anything under one means the company is running a very efficient operation, especially when it comes to debt. And then there's General Mills at 1.4. And the only one where it's kind of icky is PepsiCo at a 2.3. The ratio that you want to see is 2 and below. 1 and below means excellent. Anything under 0.5 is like world class. When you go above a 2, that's when it starts getting a little risky, but it's because I think they're going through a pickle right now that I think they can handle and overcome. And in the case of McDonald's, their debt to equity ratio is negative 10.3. And that's because they have negative shareholder equity, because they are a real estate company operating as a restaurant chain. But more so than that, whenever McDonald's has available cash left over, they do share buybacks and dividends. And when a company does share buybacks, it reduces the shareholders' equity, and that's why we're seeing a negative number here. And so on paper, it makes their debt look worse than it really is. However, when we look at their free cash flow situation, it's a beautiful picture. So McDonald's is not a company that I would dismiss due to their debt to equity ratio. You have to read between the lines. And as you can see on the right side of your screen, it's their annual free cash flow from 2010 all the way to 2023. And I always say this, in a free cash flow, what you want to see from a company is a trend that is consistent, posting the same numbers year over year, or in a perfect world, for the free cash flow to be growing year over year, or at least in the right direction. And in the case of McDonald's, in 2010, they posted $4.2 billion of free cash flow. And this past year, they posted $7.3 billion. And in the trailing 12 months, the past 12 months right here, that's what TTM means, they posted $6.5 billion. So it does look like McDonald's is a cash-heavy business. So now that we know why they have a negative debt to equity ratio and their free cash flow is amazing, let's go ahead and give them a pass on their debt to equity ratio move right along. Hopefully by now you can see eye to eye with me on what I'm seeing to label these guys the winners of the food stocks if they're going through a dip or fear selling from Wall Street. And now let's go ahead and talk about the potential losers of the food industry. The other side of the spectrum, the food companies that are doomed are the ones that make gas station snacks. You know, the foods that are sold at convenience stores, the really sugary, high calorie, delicious stuff. The very nature and identity of a Twinkie is a Twinkie. It's almost impossible to make a cupcake healthy, unless of course you change the ingredients and composition of the recipe to make it into a healthy snack. But then the question is, how profitable will the margins be once you substitute out the artificial crap with healthy stuff instead? And to compensate for the healthy ingredients, the prices are going to have to go higher as well. And if the prices get out of hand, will people still buy the cupcakes? Well, to help us answer that question, let's go ahead and look at these three different companies and their portfolio. First up is J.M. Smucker, the parent company of Hostess Brands. J.M. Smucker makes snacks like ding dongs, cupcakes, fruit pies. Oh my gosh, these are all the nicknames that your boyfriend gives you. They also have ho-hos, donuts, mini muffins, Twinkies, snowballs, zingers, everything and anything to do with sugar, pastry, delicious goods. So that's J.M. Smucker. And then there's also Bimbo Bakeries. They make those little bites, you know, the muffins and cupcakes, and they also make Entenmann's donuts and all sorts of different varieties of dough and bread. And then, of course, there's Conagra Brands. They make Slim Jims, they make those frozen meals made by Marie Callender's and Banquet. So to answer the original question, are people going to continue to buy these unhealthy pastries and goods and snacks at the gas station and convenience stores? Yes. Absolutely yes. There is and always will be a customer segment for these brands. If you think for 1 second that everyone is going to magically become a vegan and a healthy eater because of the healthy food mandate, then you are absolutely out of your mind. As humans, we often know what the right thing to do is, but when we have the option to shove a highly processed synthetic pizza into our mouth versus a bowl of salad, what do you think we're going to do? We're going to go with that route more often than not. So in the short term, at least for the next 4 years, I will say this. I do think those three brands are going to take hits on their food divisions because they do need to make healthy alternative ingredients for their foods because of the RFK Jr. leadership. But out of those three, I feel like the one that should do okay is Conagra because their portfolio seemed pretty diversified. But for the most part, I do think these three are going to suffer more than the five winners that we talked about. thought. I could be wrong, but it's what I think. So with the sell-off, I think it could be a good rebound opportunity when they're in the undervalued territory, because 10 to 20 years from now, these foods are still going to be rocking, thriving, and filling the bellies of the fat truck drivers that are all around the United States. And with that said, I'm going to say this. Junk food has a place in our society. It's here today and it's here to stay. Healthy junk food, though, is going to be a game changer. So if J.M. Smucker can magically turn the Twinkie into a healthy snack, dude, game changer. My mind would be blown. And the sentiment among Wall Street is going to be super bullish on the company as well. We'll see what happens. So after taking into consideration everything that we talked about here today, what is my game plan? What am I going to do? Well, to answer that question, with how things are right now at their current prices, I personally like PepsiCo and Hormel the best. They're tied for first place. And then in third place would be General Mills, and fourth place would be McDonald's, and fifth place would be Walmart. But that does not mean that Walmart is bad or anything, but that their stock price right now is slightly overvalued in my opinion, so I would rather buy the ones that are more undervalued. If each one of these companies reach my price targets, the dollar amounts that you see on your screen right now, like $55 for Walmart, $65 for General Mills, $30 a share for Hormel, and so forth, then Walmart would be my number one choice. McDonald's would be number two, Pepsi would be number three, Hormel number four, and General Mills number five. And even though General Mills is at number five, it does not mean it's bad or anything. It's the way that the cookie crumbles, and they're all pretty good options. Now the question is, will Walmart ever reach $55 a share? I don't know, but I'm willing to wait. And that's the cool thing about investing, right? We don't have to invest into the prices that stocks are at right now. We can play the waiting game. We can have our investing thesis say, hey, I want to buy into it when it's at this price. We could dollar cost average. We could do lump sum. It's beautiful. And as a disclaimer, do keep in mind that rankings are always subjective. Like when you have one too many beers and you go around telling people that the best artist and singer in the world is Taylor Swift, knowing full well that you're a 51-year-old balding male with a beer gut. You and I both know that that's a pretty subjective hot take. Because to me, as a 30-something-year-old, I think the best artists in the world right now, Fleet Foxes and Bon Iver. Just my personal opinion. And on that note of subjective rankings, I truly think Crocs and Hey Dudes are probably one of the most comfortable footwear out there, especially if you're slipping on a pair to go grill some meat in the backyard or to go walk your dog. I just wish I had the balls to invest into their stock, because based off of a surface level evaluation, I think that Crocs is criminally undervalued. But I can't say with confidence that's the case, because I have not done my own due diligence and analysis on the company to figure out if it is indeed undervalued. So what do you think? If you disagree with me, please let me know, because I'm pretty open-minded. Not to the point where I'll ever convert to veganism, but I'm open-minded to different opinions, ideas, and I like it. I welcome feedback. My finishing statement is this. Food companies have weathered the storm throughout the decades, through different trends, consumer preferences, and even COVID-19. As such, I'm bullish on food and restaurants because let's face it, no matter the technological advancements that we make as a society, we're always going to be eating. Eating is essential to human life. If these 5 winners ever go on a dip, I'll be more than happy to buy into these high-quality companies on a discount. And if you made it to this point in the video, I just want to share something with you. I wanted to let you know that if you feel like you're not where you want to be in life, that feeling of disappointment, shame, and guilt is something that I know all too well, and I want to tell you right now that it's okay. You see, I used to operate with a mindset of delayed gratification on everything, to the point where I would embrace suffering in whatever I was doing at the moment and sacrifice everything else in the present tense. And it got to the point where I never celebrated my victories or accomplishments. Yes, I went to my graduation party and promotion events, but mentally I was checked out. because I was laser focused on the next goal, the next degree, the next promotion, the next task, so much so that I disregarded much of my 20s chasing that next something. And that's why I just felt compelled to say this to you today. If you're not satisfied with where you are and who you are today because you're trying to change or chase a dream or a goal, that's normal and absolutely okay. But remember, life is meant to be enjoyed. So I hope you find a balance between pursuing your goals and finding time to enjoy this moment, because remember, it's about the journey, not the destination. Because if you only focus on the destination and you disregard your personal relationships, your health, your brain, your mental health, your hobbies, then you throw away the precious gift of the present moment. And that's why they call it a gift, because the present moment you're never going to get back again. So you might as well try to enjoy it, right? So the lows and the highs, they're all a key part of your story. All that to say, find some time to do something that you enjoy here and there. Don't disregard everything in pursuit of your passion. That's the fastest way to be miserable, lonely, and to hate yourself. It's okay to work hard, but make sure that you also take care of yourself. So sometime today, find some peace, do some meditation, do some stretching, rub your nipples a little, do something other than stressing about work. It'll do wonders for your mental health. With that said, I love you, stay safe, and I'll talk to you next time. Peace.